My name is Priya Mathur, and I sit on the board of CalPERS and also on the board of the PRI. So I'm very delighted to be able to moderate this important session on impact investing. We only have 45 minutes and now maybe a little bit less for this session, including questions. And I know everyone will want to get to the gala dinner at Guildhall, so I'm going to keep the introduction short. I will just quickly introduce Sir Ronald, even though he's not here yet, so that I don't have to do it when he arrives. You will no doubt have heard of him. He has been dubbed the father of social investment, as well as the father of British venture capitalism. He has made a lasting impression on the British and global financial sector. Under his chairpersonship, the UK's Social Investment Task Force made really important connections between community development and finance. And he sits on a number of boards, has founded important companies in the field. Yvonne Bakkum is the director of FMO Investment Management, the Netherlands Development Bank, which develops and markets sustainable emerging market propositions. FMO uses a double approach in its impact measurement model, looking both at client data and at country and sector-specific macroeconomic data. So I'm going to start with a little bit of a provocative question. I think there's quite a bit of confusion about what impact investing actually is, and some challenge whether it's even relevant for institutional investors. So could you share your thoughts on the subject?
Absolutely. I'll go into the latter part of your question first, because this is almost a rhetorical question. Is impact investing relevant to institutional investors? My answer is, how could it not be? When you have responsibility for decision making on allocating capital, and you know that any capital investment has some form of impact, that brings with it the responsibility to think about it, what you can do with that capital. And this morning someone said, well, we may be called agnostic in terms of responsible investing. Well, I believe as a serious investor, you cannot afford to be agnostic on impact investing. And well, I can maybe give some examples later, that it's actually very inspiring if you see what you can do, what the positive impact is that you can have with your capital without compromising on financial returns. So it's absolutely very relevant. Then the debate on what it actually is. Of course, you need to know what you're getting into, and things need to be defined. But personally, I think we have debated long enough what impact investing is. And I think parties more or less agree that it is a form of investing that has a positive impact, and that is from the outset meant to have a positive impact on either the environment or on people, and also has a market rate or at least some form of financial return.
I think you've raised what is, for some, the central question, and that is, in order to accomplish this impact, must you give up returns?
No, you don't need to do that. And well, FMO is a development bank. We have an 8 billion euros portfolio of emerging market investments that is very profitable and that compares favorably to benchmarks. Well, everything we do is also meant to have an impact. So I'm convinced and have the data to prove that you don't have to give up on returns.
Great. Would you mention that you have some examples you would like to share?
Yes, you mentioned in your introduction that we look at several aspects about impact. And we have also evolved in that sense, because as a development bank, we were established to have impact. So we used to take that impact for granted. And we were not very specific on what that impact was. And in recent years, we've come to realize that we need to be more explicit about it, to explain to our stakeholders what we are achieving, but also to steer our investments in the direction of even more impact. So we are now targeting and measuring our impact. And if Sir Ronald were here, he would have said what defines impact investing and what differentiates it from responsible investing is that you target and measure the impact. So that's what we do. And we look at two main things. And it sounds very simple to look at only two things. Well, we started this whole process of impact measurement bottom up And our staff were very engaged and very enthusiastic, and they came up with 43 indicators. And of course, all these indicators were very relevant and very useful. But we soon realized that we could not steer or manage our business looking at 43 indicators. So we boiled them down to the two that we believe are most crucial in emerging markets. One is job creation. So that's the jobs created, but also the indirect jobs supported through our investments. And on the environmental side, we look at the avoidance of greenhouse gas emissions, which has steered our investments much more into the direction of renewable energy. And there are plenty of opportunities, because when we decided that we wanted to double our impact in terms of jobs and halve our footprint in terms of greenhouse gas emissions, we set ourselves the target to have 80% of our energy portfolio in renewables by 2016 or even 2020. And today in 2015 we already have 79% of our energy investments in renewables. So that proves that there are good opportunities, and I would not buy the argument that I sometimes hear from institutional investors that there are not enough impact investing opportunities.
Well, it sounds like we're approaching perhaps a convergence between impact investing and responsible investing. What do you think mainstream investors can learn from the work that you and others have done in the impact investing space, and particularly around risk management?
You can actually have positive impact and at the same time make attractive returns. They can learn that from our experience looking at our numbers. What is also important to realize is that impact investing is available across asset classes. And well, while we are only active in the private debt and private equity space, I know, and I've read and talked a lot about impact investing, I know that also in the public markets impact investing opportunities exist. So still it seems that some institutions place impact investing in venture capital, high risk private equity, and of course there are really appealing opportunities in those asset classes, but it should be clear to investors, for instance insurance companies who prefer to focus more on debt investments, that also on the debt side you can find very impactful investments. And for instance green bonds, which are relatively easy to start with, but it's also a positive approach towards your fixed income portfolio. So that's really what I would advocate. Look at this in a broad sense across your portfolio.
And so you have spent many years at FMO now, I think, and can you discuss with us some of the challenges of growing an impact investing fund?
Yes, and maybe it's not so much from our own experience. Well, the challenge is that you need people to do it. Well, we are the extreme example because we have almost 400 staff to manage our 8 billion euros portfolio. Well, I'm pretty sure that compares very badly with your staff numbers and your portfolio sizes, and there's no need for you to enlarge your teams to that sizes, as long as you cooperate with parties who know what they're doing in impact investing. In our particular case, because all the investments are emerging markets investments, many of which are frontier market investments, they are very labor intensive. They just require a hands-on approach. And I just told you that when I was joining FMO and covering Latin America, I was traveling there maybe 8 or 10 times a year. And it shows that you cannot do these investments from behind your desk. You really need to go after them and cooperate with the parties that are on the ground.
So you do that, you partner with locals?
Always, yeah. Yes. That's very crucial in our strategy, especially in private equity. We have a strong partnership model based on investing in funds and co-investing with fund managers. But also on the debt side, we have strong local networks that are very important in terms of deal sourcing, but also in terms of knowing who to deal with, referencing new clients, new parties, because you need to be comfortable about that.
So have you seen the impact investing arena change significantly over the past decade? Where did it start? Where has it come to, and where is it going to be 10 years from now?
It has changed a lot, and it's still changing, and overall I'm very positive about where the market is going, very optimistic, but at the same time I'm also getting a bit impatient. When you look at institutional investors, where clearly the interest in impact investing has increased significantly, especially last 5 years, I would say, that's when it really picked up, but still there's so much discussion and so much research, and people are sitting there, we were joking, they sit there with their notebooks and not the checkbooks, and it's really about time that people move, and some people do. When I say things like that I'm impatient, by no means does it imply that I'm not very aware and positive of those initiatives that are already taking place, and many institutions, and I think you in this audience are a very likely audience also to move into impact investing, or be at least among the first movers or early adapters, because you already have this sense of responsible investing. And responsible investing and impact investing, well, it's simply taking it a few steps further. And you can never be an impact investor without being a responsible investor. So I would think it's a natural evolvement in your approach.
So what do you see as the issues ahead for impact investing? Where are there still impediments? Where do you see movement needing to occur?
Yeah, I think in practice there is an impediment, and I know that's probably for reasons that you should actually applaud, but in certain institutional investors, the definitions of impact investing tend to be very narrow. At the same time, the ambitions and the size that is needed to make impact investing meaningful in the context of overall portfolios, you need size. But the combination of very narrow definitions and huge size ambitions is a difficult one. So when you have agreed with your board that you can only do education in sub-Saharan Africa or healthcare in frontier markets, then you should also accept the fact that it will remain a marginal part of your portfolio. So when you're serious about this and want to mainstream it across asset classes, you should also be a little bit pragmatic in defining impact investing, and well, maybe the example of FMO, where we've managed to come from 43 indicators to 2 that are still very meaningful and helpful in steering our business, maybe that can inspire you.
You've focused to these 2 measures. Do you think you might expand that at some point to include water or other issues?
Yeah, it's not that we are not looking at other issues, right? We are also capturing other impact data. We are, for instance, in our renewable energy activities, we are looking at how many people we are giving access to the grid. We're looking in our agribusiness, how many smallholder farmers do we reach. We're looking in our financial institutions portfolio, how many SME companies have benefited indirectly from our financing. So we keep track of more than just these 2 indicators. Yeah.
Great. Now, have you considered what the role of the new SDGs might be in the impact investing arena?
Well, I'm not so much into politics, but I did look at these new SDGs this morning. Well, the good thing is there are so many of them that there's always a fit somewhere, right? There are 15, I think, 17 development goals. So definitely there is a fit. And also I have been advocating the need to scale up impact investing. And this, of course, is because the scale of the world's problems is also very huge. We still have more than 1 billion people in poverty. We have more than 1.3 billion people without access to electricity. We have 800 million people severely undernourished. So these problems are huge. So in order for impact investing to contribute in a meaningful way to solving these issues, we really need to be ambitious about scaling it up. And our CEO at another conference made the somewhat provocative remark that I wholeheartedly agree with: if it's not scalable, it's a hobby. So I really advocate to grow these portfolios.
So institutional investors are increasingly looking at, as long-term investors are looking at environmental, social, and governance as risk factors to the long-term performance of their portfolios. What can we learn from impact investing that's relevant to that view on our portfolio management?
That's actually interesting, and this angle of looking at systemic risks and addressing these risks through your investments is an interesting one. And I liked the remark that someone made this morning to not talk about financial and non-financial issues, but talk about financial and future financial issues, because the way certain trends are evolving, these issues that some may consider non-financial are deemed to have quite severe effects later on, and then they will also hit your portfolio financially. But to be honest, I don't like to preach impact investing from fear. There is much more positive inspiration that should drive you towards impact investing, and not so much the fear of the negative consequences when not doing it.
Well, I appreciate that, although I think for a lot of the mainstream investors, risk management is sort of the entry point for thinking about this. So what do you think it will take to change the behavior of the capital markets to better embrace impact investing?
Well, in relation to my impatience, I have to acknowledge that it will take time to start with, but it will also take brave individuals, and I've seen that in many cases, either in boards of pension funds or in investment teams. Very often the passion of one or a few individuals has been driving the growth of impact investing within certain institutions, and that is something that we will continue to need. Education, awareness. I really love the theme of this conference where PRI says we are moving from awareness to impact. And yeah, when you are aware of the impact you can have, it also triggers you to want to have it. And in that sense, for instance, in our own portfolio, when I said we took impact for granted and we didn't measure it, it also meant it was a bit vague to our own staff and to ourselves what we achieved. And now we said between 2012 and 2020 we want to double our impact, i.e. double jobs created and supported. And we did a baseline measurement over the years 2010-2012, and we saw that our new investments in those years on an annual basis created half a million jobs. And that may sound not that much, but if you add it up going towards 2020 and assuming we realize this ambition to double the impact, then by 2020 we would have supported more than 7 million new jobs. And you know, that is the entire labor force of the Netherlands. So it's really meaningful in the context of emerging markets especially. That's
quite a stunning number.
Yeah.
So how did you land on these two out of the 43 that you first considered, these two measures?
Yeah. Well, when we were established in 1970 by the Dutch government together with large Dutch banks, our mandate already was private sector development, meaning stimulating entrepreneurship with the ultimate goal to alleviate poverty. So for us, local entrepreneurship and poverty have always been key themes, and these of course link very easily to jobs. And I can sometimes get a bit angry with people when they talk about impact investing and then say about, for instance, making private equity investments in mid-market companies in Africa, and they say, no, that's not impact investing because it's mere job creation. But I think when you are in a country where unemployment is huge, mere job creation is really what it takes to take the country to a next level and improve the lives of people.
Well, I think we can now welcome Sir Ronald Cohen to the stage. Thank you for joining us.
I have to apologize. I knew Murphy's Law, which is that anything inconvenient happens at the most inconvenient time. I didn't know Murphy's wife's law, which is that Murphy was an incurable optimist.
Well, we've been having quite a nice conversation here, but maybe I'll turn it over to you now.
I'm so sorry. Yeah.
We started with, as I think we chatted earlier about, with the question of what is impact investing and why is it relevant for institutional investors?
So one of the definitions of impact investing, and the one which the G8 task force came to, is any investment which delivers measurable social returns, including environmental, alongside financial returns. And if you adopt that definition, then you begin to understand that in theory, across all asset classes, you will have impact investment opportunities. And if I look ahead 5 to 10 years, I can see that we will have impact public equities, impact fixed income, impact alternative assets. You'll have impact venture capital, impact private equity, impact real estate. You'll even have impact absolute return for those who aspire to find uncorrelated investments, which will be investments in social impact bond funds and development impact bond funds. But today, most of the opportunities are in the private space. Most of the opportunities are in the area of social venture funds, with some fixed income and some investment in social impact bond funds. What we're beginning to find is that the flow of opportunities is increasing in response to the flow of capital. And we are also discovering that investors and consumers have cottoned on to the notion that when you look at an investment, it's no longer sufficient to measure risk and return. You have to measure risk, return, and impact. And as you begin to have the tools to measure impact, the cost of social issues is on the web in the UK. 600 social issues are on the web. If you have a social impact bond yielding 7 or 8%, and you rehabilitate 1,000 prisoners who don't reoffend, you know that that costs the government £22,000 a year. You can calculate the £22 million financial benefit, and it can translate into an IRR. A social IRR. And I think to answer your question, Priya, I think as investors begin to understand that they can pick investment opportunities that deliver measurable social impact at the same time as attractive financial returns, the money will begin to go to those opportunities.
And you believe that this is a scalable space where the panoply of institutional investors globally can access this space?
Yes, in the G8 task force report, which I would encourage you all to read, it's entitled The Invisible Heart of Markets, impact being the invisible heart, guiding the invisible hand. We talk of the first $1 trillion. And we're talking of, I think, a seminal change. In the 19th century, nobody measured risk. You only measured financial return. In the 20th century, we began to measure risk and return. And in the 21st century, we are going to be measuring risk, return, and impact.
Terrific. So you mentioned risk. What can mainstream investors learn from the impact investing space with respect to risk management, and particularly long-term systemic risks?
So one of the advantages of investing, say, in a social impact bond is that your return is dependent on the ability of an organization to reduce the rate of recidivism, to reduce the number of homeless people, to reduce the dropout rate from primary school for girls in Rajasthan, or the dropout rate from computer studies for people from underprivileged backgrounds. These are efforts that are not correlated with the stock market. So one of the big advantages of some of the securities in the impact space is a much lower correlation. So it brings diversification and increased return. They are more illiquid today. Over time, that will change. As it changes, the correlation will also change. But we're beginning to find institutional investors making allocations to impact investment. So in Australia, for instance, QBE, which is a global insurance company based in Sydney, QBE has a $100 million allocation to social impact bonds and development impact bonds. And I think the first step for those of you who are institutional managers in the hall today, the first step is for your organizations to recognize, just as your organization had to recognize when venture capital came along 30, 40 years ago, and then private equity after that, that a set of skills is going to be required to look at opportunities in this space, and that you have to start by making an allocation and then bringing a dedicated person to look at putting together a portfolio of impact investment opportunities.
So do you think achieving this $1 trillion of social impact investing, do you think that requires a change in the behavior of capital markets?
I think it is going to bring a change of mindset among investors, which will change capital markets. Robert Shiller, the Nobel Prize winner, at the World Economic Forum, made a speech in which he said social impact bonds are one of these innovations that can revolutionize capital markets. And if you think about what's happening in the world, if you think about the fact that governments just don't know how they can cope with social issues, on the G8 task force we looked at the gap between expected expenditure on social issues and the expected supply of social services. And the gap is huge, and it keeps increasing with an aging population in many countries. So if you look at the fact that governments really don't know how to cope now with social issues, they need innovation, they need new ways of doing it, they need to begin to measure performance so as to be able to compare what works with what doesn't work. Very little is measured in government today. You look at entrepreneurs today, the millennial generation, that's looking for meaning, doing good and doing well at the same time is the slogan of that generation. And you look at the investors who've signed up to the United Nations Principles for Responsible Investment, $50 billion worth of assets. Clearly something has changed. And with the development of the first social impact bond in 2010, the notion that in the social space you could measure nothing, that things that count can't be counted, began to be dispelled. At first people said, well, this first social impact bond is about prisoners who reoffend, and there's plenty of information on police computers. So it's the only case where it'll happen. But today you have social impact bonds, homelessness, taking unemployed teenagers into work, adoption, foster parentage. You have it for single mothers who've had abuse and have children in Canada. You have it for the prevention of strokes now in Canada. You have it for the prevention of diabetes, about to be launched in Israel and in Palestine. People are innovating and are proving that you can measure an improvement in a lot of social issues. You can't measure everything that is worth doing, but if you look ahead 10 or 20 years, as Jeff Rakes, who was CEO of the Gates Foundation, put it. Impact investment is disrupting the model of philanthropy. If you look ahead 10 or 20 years, philanthropies will not just have a grant program. They will have commitments to outcomes funds that pay on results achieved in tackling the social issues we've discussed. And they will have an allocation from their endowments to impact investment. So we're disrupting the philanthropic model. We're disrupting the way in which governments think about the ways in which they tackle issues. And we're disrupting entrepreneurship by bringing this second dimension, measurable dimension. And for me, it reminds me very much of the days at the age of 26 when I entered what became the venture capital business. Technology disrupted everything. It disrupted every industry. It disrupted our lives. And the people who brought it about were in large part youngsters without business plans, without business experience, who had a view of the future, a vision of what technology can do. I think unlike technology, in the social space, every age can contribute and every country can contribute. Silicon Valley had a specific ecosystem that we've been unable to replicate in most places. I don't think the same will be true of social entrepreneurship and investment. And so I think the field is wide open as to who will end up being the leader in the impact investment space. And the G8 task force has been succeeded by the Global Steering Group on Social Impact Investment. And I can't give you the names, but 5 countries have been admitted, which will come to the Global Steering Group in addition to the G7 countries, Australia and the EU. If you had been at the plenary where these countries presented, you would have had to pinch yourself. In every country, you've got an organized national advisory board focusing the government on the policies that are necessary to get impact investment to take off. You've got teams of people working on launching social impact bonds. You've got teams of people releasing unclaimed assets from banks. Japan is just releasing $800 million from bank accounts that are more than 10 years old, and is going to use them to set up a big society capital-like capital wholesaler for the impact sector. And so you're beginning to find people of like mind across the world. And what we really need in order to break through is what we had in the venture capital industry. When the United States changed the regulations around the duties of trustees, of pension fund trustees, corporate pension fund trustees, through the ERISA legislation, the size of a venture capital fund went from $2.5 million before 1978 to $30 million in 1979. And governments are working on changing these regulations. In the United States, the National Advisory Board is working on changing the ERISA regulations again to bring within the prudent man rule impact investments. And here in the UK, the government has a government bill going through, which is very likely to become law, saying to the trustees of foundations, you have an obligation to deliver an acceptable return. But that's not just a financial return. That's a combination of a financial and a social return. And if that empowers trustees of foundations and trustees of pension funds to begin to make allocations, then I think we will begin to see significant capital flow into the space. But it does take time. I started trying to raise a venture capital fund in 1972. The first venture capital fund I raised was in the UK in 1981, 10 million pounds. Today, APAX manages $50 billion. But if I plot to the growth of Bridges Ventures, which I co-founded, which invests in the poorest areas of Britain and today manages $1 billion, it's the same curve we had at APAX, which gives me the conviction that this is a major change.
Well, on that optimistic note, I think we should turn to the audience for a few questions. We are a bit constrained on time, but if there are questions in the audience, I can't quite see any hands. There's one over here. I think microphones will come to you.
Well done.
Number 2.
Hi, Vicky Backish from BMO Global Asset Management. There's a lot of great work that's been going on around metrics in the private area and measurement in the private area, and you talked about the importance of scaling this up to other asset classes, including listed equities. What can you say about some of the challenges of finding meaningful metrics at the level of listed equity, which is a very large, very complex companies with multiple impacts?
Well, as I said, we're not in listed equities, so I wouldn't feel capable responding to your question, sorry.
I think the issue of big corporates and impact is clearly a very important one, but it's a very complex one. And what we see happening in the corporate space today is large corporates, say like Danone and Mars, getting together, raising a $120 million impact fund to which they contribute, with the objective of taking 1 million or more people out of poverty in their supply chain. So you're seeing companies getting involved in impact investment. They're not transforming themselves into impact organizations. So I think it'll be a while before you begin to find big companies adopting business models that deliver measurable social goals together with their financial goals. It's more likely that the innovation will come from younger companies or medium-sized companies that begin to establish social objectives, the metrics for measuring them, and then monitoring their progress. So I was at a meeting yesterday at Bridges, where it was beginning to emerge that quite apart from supporting startups which have both these goals, there are some medium-sized companies that need capital and that are motivated by a desire to do something meaningful for society and that have begun to define goals. So companies are actually coming to raise growth funding because they want to turn themselves into impact organizations. And in September in the UK, later this month, will be the launch of B Corps, Benefit Corps. Are you all aware about Benefit Corps? Have you talked about them? So in the United States, about 10 years ago, legislation began to be passed to allow companies not to maximize profit if it's in pursuit of a social goal. And this legislation has been passed in over 20 states now, and there are another dozen states in the pipeline. An organization was then set up called B-Lab to rate the performance of companies and to give them a stamp, which is the B Corp or the B-Lab stamp. We will be launching later this month B Corps in the UK. I can tell you now that there will be tens of companies in the UK adopting the B Corp form. The first NASDAQ company to be a B Corp, to go public, was Etsy. Some of you may be aware of Etsy. It's a model where basically women, mainly across the world, that are involved in preparing artifacts of different kinds can manage to access markets through them, and a very successful company. So the movement of profit with purpose is also progressing. And I think it's those companies like Tom's Shoes in the United States, for instance, which was funded by Bain Capital at a $600 million valuation. It's those companies with intrinsic business models that achieve impact together with a financial return that are going to be the impact equities of the future. So there is, I'll just make one last, Priya, forgive me, one last comment. There is a set of companies like Danone, like Unilever, that are working hard to work out how they can measure the impact across all of their operations, but as you say, that's very complex.
Well, on that inspiring note, I think we're going to have to call this conversation to a close. We have reached the end of our time. Please join me in thanking our speakers, Sir Ronald Cohen and Yvonne Bakkum. A great pleasure. Thank you.